Hello and welcome to Yahoo Finance's special breaking news coverage of the December Fed decision. I'm Josh Lipton here with my colleague, that would be Julie Hyman. We are just moments away from the Fed decision. Markets, let's take a look at the popular average here. The Dow's up about 145 points. S&P 500, your broad gauge, is basically flat right now. Tech-heavy NASDAQ is down about 0.4%. But this is it, Julie Hyman, the final monetary policy decision of the year. The economist Stephen Stanley, you know Stephen, he's a smart guy, friend of the show. Here's what he said. The setup for this meeting, he said, Julie, as dramatic as Fed watching gets. That's what Stanley says. Financial markets, we know they're pricing in a cut by about 25, though we know it's also been contentious among our central bankers.
The drama has nothing to do with the rate decision itself. As you say, it is broadly expected that the Federal Reserve will cut rates by a quarter point at this meeting. It's more what kind of dissent do we get amongst the Fed members who wanted a cut, who didn't want to cut, who wanted to cut more, Stephen Myron, right? Like that's where the drama is going to come from. And then there are now a lot of questions around what's going to happen in 2026. Today we get the dot plot, right? The summary of economic projections. So we'll get another crack at what's going to happen with rates next year, or what they think will happen.
And it's contentious, and I think so even maybe more focus on Jay Powell at the presser, because the wordsmithing he has to do with all that debate and tension and how he kind of walks that line, the messaging to keep the camp happy, going to be interesting to watch.
Yes, it will be fun indeed. And as you noted, the stocks aren't doing much ahead of all of this because they're waiting to hear what Jay Powell has to say. What has been interesting in recent days is that bond yields have actually crept up a little bit. And so that has been something that is a little bit unusual, right, in the face of an expected rate cut.
Yes, a question. All right, we have it here. Jennifer Schonberger has the decision. Jennifer.
25 basis point rate cut, the Federal Reserve lowering their benchmark interest rate by a quarter percentage point to a new range of 3.5 and 3 3/4, marking the third rate cut in a row this year. Officials see just one rate cut next year. Now, this was a split decision with dissents on both sides. Austin Goolsbee of the Chicago Federal Reserve and Kansas City Fed President Jeff Schmidt both favored holding rates steady instead of cutting. On the flip side, Stephen Myron, the Fed governor, preferred to cut by a jumbo rate cut of 50 basis points instead of 25. Now, there were 6 members of the Fed who would have preferred not to cut rates today. Of course, we know that 2 of those were Goolsbee and Schmidt. Looking ahead to next year, 4 see just 1 rate cut, 4 see 2 cuts, 2 see 3 cuts, 1 sees 4 cuts, and 1 sees 6 cuts, ostensibly Stephen Myron. Now, Fed officials signaled restraint for further rate cuts next year in their policy statement, adding back language to that statement saying that, quote, in considering the extent and timing of additional adjustments to the target rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As I said, the median is for 1 rate cut next year as Fed officials revised higher their outlook for economic growth and revised lower their outlook for inflation. Next year, inflation is seen falling to 2.5% compared with 2.6% previously, and a level of 3% to end this year. GDP is seen rising by 2.3% next year versus 1.8% previously, so a bit of a jump there, while GDP this year was revised up 0.1% to 1.7%. The unemployment rate expected to be clocking at 4.4% next year, which would be down 1/10 from 4.5%. The unemployment rate currently stands at 4.4%. And one other thing to add, officials will resume purchases of short-term treasuries to hold their balance sheet steady as they look to keep that ample reserve regime in place. Back to you.
All right, thank you, Jennifer. So, Julie, here's your headline. So, all right, so you get your cut. It sounds like Goolsbee, Schmidt dissent in favor of no rate change. They'll consider the extent and timing of additional adjustments. It does still look like you get another cut seen for next year.
But only one, which is pretty incredible given where we were, right? We were, the market was pricing in more cuts. It went from 3 to then pricing in 2. Now the Fed itself is saying only 1. Now, listen, you always got to take the dot plot with a grain of salt, right? This is what the Fed members themselves are projecting. As we know, there is an unusual amount of dispersion and dissent within the Federal Reserve. We also know we're going to get a new chair of the Federal Reserve, so that dot isn't even on there yet, but we know where that dot's going to be. It's going to be lower than it is right now. Probably inevitably whoever the president nominates to take the place of Jay Powell. But still, it has been a real shift in these expectations. And I think that is one of the big sort of first blush takeaways for me.
What's interesting, too, is you wouldn't say the Fed is flying blind right now. You would say they have some blinders on. I mean, the economic data, they don't have. They will, I mean, you would expect them to get a rush of data soon,
Right.
but interesting, there were some, including folks on this set, Julie, who were sort of out of consensus, who were saying they didn't think you would get a cut. In part because of that, because they just don't have the data.
Okay, there are two things I would say to that. One, first of all, Jay Powell himself has called it fogginess, right? That's what they're operating under right now. But to say that they wouldn't have cut today, that is not how this Federal Reserve operates, period, end of story. They don't do something surprising like that to the market.
Because you think Jay Powell does not want to wake up and see himself on top of the fold front page tomorrow?
There's just no precedent for that in recent history that they would surprise the market like that. There was always going to be a cut today. Not always, but you know, it's not. That's what's
seemed likely.
That's what's going to happen.
Let's get to Yahoo Finance's Inez Ferre now with a check of the market action. Inez, what are you seeing?
Josh, after that decision, we have seen the markets going higher. We are looking at the Dow that's up about 0.5%. It touched session highs. You can see the mark up there. And then also the NASDAQ trimmed its losses from earlier. It was down 0.4%, now down 0.2%. The S&P 500 up 0.1%. And the Russell 2000, the small caps that have been hovering near highs, up 0.2%. Just taking a look at the 10-year Treasury, that's been hovering at 4.17, and the 30-year Treasury at 4.7. Also, the U.S. dollar index that has been below 99 today, little movement there with the dollar index. Taking a look also at gold futures, those are little changed, and silver futures up 0.4%. Silver has been near all-time highs. Looking at equities under the hood, well, taking a look at Bitcoin here. Bitcoin up, down more than 1%, near 92,600 per token. Traders had been talking about if this were a hawkish cut, this wouldn't be great for a Bitcoin rally year end. And then just looking at where we're at with the sector action, we are seeing industrials, healthcare, financials. These have been the leaders throughout the day as we have seen mixed markets throughout the day, and a mixed picture here that you're seeing on the NASDAQ 100, guys.
All right, thank you, Inez. Now, for more on the Fed, let's welcome in here Stephanie Aliaga, Global Market Strategist at JP Morgan Asset Management, along with Jeff Klingelhofer, Aristotle Pacific Managing Director and Portfolio Manager. Welcome to you both. Stephanie, I'll start with you. You got the headline, you got the news. What do you make of it, Stephanie?
Thanks, Josh. I think this was pretty close to what markets were expecting. We were all bracing for a bit of a hawkish cut, and I think that's what we got. When you look at the summary of economic projections, this is an economy that, despite of this bit of a gap in the data recently, we know that the economy is on a pretty good trend. In fact, they upgrade their GDP production for next year to 2.3 from 1.8. That's pretty meaningful. Beyond that, they see a labor market that's stabilizing, no change in the unemployment rate next year, 4.4. That's essentially where we are today. And in that environment, it doesn't seem obvious or likely that the Fed would really put a big weight to easing policy aggressively. So one more cut next year. Of course, we'll kind of have to see what comes with the new Fed chair and obviously the data that we get. The other thing that stood out to me was the change that they made in adding the extent and timing of further rate adjustments. That tells me that they're signaling that the bar is high for further rate cuts in the near term. So I think we're looking at a bit of a pause, which is also what markets were expecting.
Well, at the same time, why are stocks going up? We'll get to the bond guide in a minute, but why are stocks going up on this? This wouldn't, on the face of it, doesn't seem to be fantastic news for those who want continued and more stimulus.
Yeah, I think it's a bit of a relief, given, that it could have been even more hawkish, perhaps. And then also, I think there's, markets are also taking this with a grain of salt, knowing that next year we're going to get a lot of changes when it comes to the Fed, and also we're going to see a lot more data in the coming weeks and months. But beyond that, I mean, look, when you see market performance, I don't think that policy is so restrictive that it's also really posing a significant headwind to performance right now.
Jeff, as Julie mentioned, you are the bond guy. So let's get the bond guy perspective. What is bond guy's reaction to these headlines?
I'd say I'm a little bit more neutral. I don't think it's quite as hawkish as I or the market was expecting, but I think it is basically within line. But we have to keep in mind, we haven't been to the presser yet. And that's really what threw markets last time around, right? I described the last press release and ultimately the last set of minutes as spicy. I think we're going to get something even spicier this time around.
What does even spicier sound like, Jeff?
Well, with the numerous dissents, there was no easy decision. I don't think it was a slam dunk today. I think it was closer to 50-50, and I think when Powell talks about the discussion that happened in that room, that's going to come out. Because no matter what camp you are in, you come out even angrier post this meeting, and it's not an easy path forward from here.
And that also makes it sound like there would be a risk to this initial knee-jerk rally if indeed Powell comes out and sounds like this, reflects that difficulty in making the decision, perhaps.
Yeah, perhaps.
Yeah.
I think the good news is the hawkishness is because the economy is doing so well, right? That growth is intact, that the labor market seems to be stabilizing, and you've seen in recent data, despite the fact that we don't have a jobs report, that yes, hiring has slowed down, but layoffs are really muted. And that's an environment that I think markets can really perform well in.
Jeff, one theme that Julie was bringing up correctly at the top of the show, as you were heading into this meeting, yields in the long end creeping higher. Why were they creeping higher, Jeff?
I mean, I think it's a lot of things, but really where I think it is look, the Fed has told us that they have two objectives, and one of those is the employment mandate, and the other one is the inflation mandate. And what we see from today in the economic projections is the employment mandate is projected to be flat, yet they still cut. And so I think what the market is saying is, we don't believe you. You're not projected to get back to 2% inflation, and you're not doing anything about it. And so we, the bond market, we're going to be forced to react on the long end. That's what I see. I see a potential that they begin to lose control of long end rates. The market is challenging that they truly believe that 2% is where they need to have inflation anchored, because it's not anchored there today. It hasn't been in the past. And I don't see any pathway at the current pace to getting back there anytime soon.
Our Jennifer Schonberger, by the way, is still on the ground there in Washington. I want to bring her back in because this projection on the dot plot for only one more rate cut next year, Jen, what is the sort of implication of that shift in what seems to be the shift in the committee's thinking?
Well, I just want to build on what the great discussion that the both of the guests have put forth, which is that, yes, there's only one cut next year and it's hawkish, but let's look at the economic picture that the Fed has painted, and it is a better picture. It is an upgrade to economic growth. We see inflation coming down back towards their target. Unemployment projected to be at 4.4%, which historically we have cheered as maximum employment. And so this is good news, I guess, if you will, here, because if they were penciling in more rate cuts, perhaps they would see more deterioration ahead in the job market, which would probably signal something pretty bad for the economy ahead. So this is shaping up to be a good picture. Of course, the market should be rallying on this. Of course, we'll see what Chair Powell has to say in the press conference, and he is going to have a tough year in 2026 because there is a lot of division on the committee. And to the other guest's point about the Fed sets rates, but then the bond market is going to do what it's going to do. We still have inflation right now, nearly a full percentage point above the Fed's 2% target. So there needs to be some restraint in trying to bring inflation back down to target. So it seems to me that policy is projected to be in a good place given what we know right now. Of course, things could change, things could evolve as we go into next year and through next year.
I mean, things could change on Tuesday. Right? Tuesday.
Of course.
Tuesday. Sorry, Jen, I'm just bringing up Tuesday because Tuesday is when we get the delayed jobs report, right? And so.
Right. We're going to get a lot of data. You're right, Julie, on Tuesday and Wednesday and Thursday with the inflation reports and the job report. And that could change the trajectory as we go into next year.
Stephanie, one point just to build on. There were some folks on this very set who thought if the Fed cut, get your take on this, they thought the Fed has a credibility problem in that you're cutting while you are above your inflation target, and you seem to be moving sideways here. I guess their point was either decide like, okay, actually that's not a target, and our target really is a range, like make that call. But don't say it's a target, be above the target and cut into it. You risk your credibility there. Yeah. What do you say to that?
I'm sure that's a question Powell's going to be asked during the press conference. And exactly to Jeff's point, I mean, that's the risk. And I think if we get a much more hawkish Powell at this press conference, it's likely going to be because of that. They don't see inflation, core inflation, getting back down to their target until 2027. And they're cutting rates, but I think that's why the messaging of this cut, it's not that they are trying to deliver monetary easing, nor with what they're doing with the balance sheet, but really just park monetary policy back into neutral so that, they're not neither, stifling or stimulating the economy right now.
How close are we to neutral now, though, Jeff?
I feel we're there, but
if it is that, if the definition is that balance, it does feel like we're there.
Well, I think you have to look at it in Fed terms, right? What they define neutral is where they keep a constant level of unemployment and constant level of the economy, and at this point, they now project that constant level of unemployment. So I will be surprised to hear Powell say anything other than, at this point, we are essentially neutral. We will be very data dependent from this point forward. Now, they change the language to suggest exactly that. But I think trying to take out insurance cuts to provide a cushion underneath the labor market, to me, given when you talk to companies why they are engaging in this slower hiring environment and even shifting to layoffs, it's because of tariff and policy uncertainty, and it's because of AI. It's not because of a demand problem. And so I just don't think low rates helps that, but it certainly calls into question the credibility of the second half of their mandate, the part that they maybe do actually have direct control over, the inflation side. And so I think we're at neutral. I really hope that we see that directly from Powell in the press conference here.
We'll find out. Jeff, Stephanie, great discussion. You'll both be back with us after Jerome Powell's news conference. More coverage of the Federal Reserve's latest rate cut. That's straight ahead. The Fed cutting rates as expected and issuing a rosy outlook for the economy next year. Joining me now, we got David Seif, Nomura chief economist. David, great to see you as always. All right, so the Fed decision, it's out, David. What do you make of it?
Well, it was pretty much as expected in that we got the 25 basis point cut. I think there are a couple of things. First is that Powell once again shows how good he is at minimizing dissent. Yes, we had a lot of dissent, it's true, but a lot less dissent than Fed officials who were voters had indicated that might come. So that's the first thing. I think on top of that, we have a subtle but important change in the language of the statement when considering the timing and extent of future adjustments. And that really indicates that the pace of cuts is going to slow down. It's our view at Nomura that this is actually going to be the final cut under the Powell Fed, so that only covers 3 more meetings. But of course, that could be turned completely upside down based on the enormous amount of data we're going to get next week.
Well, by the data and by the new leadership of the Fed as well, post Powell.
Oh, yes.
And so when you look at the dot plot, given that we're getting a change in leadership, and I understand it's a committee and there's lots of votes, but do you think the dot plot sort of has less significance than even it usually would because we're going to see that change?
Yeah, absolutely. So we certainly expect more cuts once the next chair, who will presumably be significantly more dovish than Chair Powell, is in place. We would expect 2 fairly quick cuts under the new Fed chair. And I think really, the amount of dissent that we're seeing, even though it was less than it might have been, really does signal that the dynamics of the Fed are probably about to change in a pretty significant way, whereby the, I'll call de facto dictatorship of the chair, which has really been in place for 40, 45 years, may really not be around anymore, and we may have to really count the votes, so to speak.
Well, that then suggests that it isn't necessarily a given that when the next chair takes over, you're going to have those 2 quick cuts. I mean,
yeah, absolutely. It's a real balancing act in terms of a couple of things. First of all, how much deference will the committee give to the new Fed chair? Our view is essentially some, but not all that much. And then, of course, what will the composition of the Fed look like? If President Trump has managed to appoint a couple more people beyond just the new chair, we may have not just a more dovish chair, but a significantly more dovish FOMC in general. And then perhaps there'll be more than 2 cuts, and there'll be a lot more deference given.
David, a broader question I had for you was, so you get your cut, but you're cutting into an economy that is resilient, and now you're throwing monetary stimulus, fiscal stimulus, AI CapEx boom, and I know some have wondered whether that raises the risk of a policy error. And I'm just curious how you think about that.
Well, it certainly raises the risk that inflation stays above the Fed's target for yet another year. I think what we're seeing right now is that the Fed's two mandates, inflation and full employment, seem to be moving in opposite directions. And of course, the latest jobs data that we have and the latest inflation data we have are essentially ancient by the standards of what the Fed would normally have had at a December meeting. And so we could see those be updated both in either direction as soon as next week. And that could really radically change what makes sense for the Fed to do.
And I think we've had several people now describe the economy as in good shape. You just talked about a robust, but we've also had all these discussions about an affordability crisis, about a K-shaped economy. And I wonder, on balance, if you're looking at the Fed cutting into that environment, if it is more helpful or harmful for Americans who are struggling, since it could keep inflation intact. And I wonder how helpful, is it really going to feed through into things like mortgages or help on other costs?
Well, it seems like if we really want to focus in on mortgages, it does seem a little bit unlikely that mortgages, which tend to be based on the 10-year rate, are really going to adjust all that much in response to the Fed funds rate, which is a very short-term rate. Sometimes they move together, but in a situation like this where markets are at least wary or fearful of inflation continuing to be above target, Fed cuts happen, but then investors say, you know what, I need more compensation, a higher yield, to lock up my money for 10 or more years, and so you don't actually see those yields fall all that much. So I think that it's unlikely that we'll see all that much in the way of housing really rebounding next year, mortgage rates coming down all that much.
I'm interested, I asked the previous guest, Bond Guru, about his take, but I'm interested to get an economist view of this. Heading into this, you did see yields on the long end creeping up. Why do you think that was?
I think that this actually goes to, just what I said a minute ago about investors being wary about inflation. But I think, you have to look beyond the United States here. This is something that's happening in developed markets around the world. Japan, the United Kingdom, even some of the smaller developed markets countries, where you start to get investors a little bit wary about how much government spending is going on, how big deficits are, whether those deficits are actually, if anything, going to increase, and what is the capacity of these governments to sell bonds to finance these deficits at this price indefinitely. No one wants to buy a bond or anything else and then have the price drop on them right away. And so people are just willing to pay a little bit less. And if they're willing to pay a little bit less for that bond, that means yields are higher.
Just quickly, finally, if it was up to you, who would you pick as next Fed chair?
I'm gonna take the fifth on that one and say, I think that what we've really focused in on now is it seems like President Trump, which is typical for how he has chosen key appointees, really values a staunch loyalist. Kevin Hassett, who seems to be the front runner, clearly fits that bill. So would Governor Myron. So would Secretary Bessent. And it seems very likely that it's going to be one of the three of them, most likely Hassett, given some of the recent talk.
Right.
A prudent response, David, as always. Thank you.
I apologize, I can't do more.
No, thank you, David. We appreciate you coming on.
My pleasure.
Well, the Fed cutting interest rates by 25 basis points. For more reaction, we're bringing now Esther George, former president and CEO at the Federal Reserve Bank of Kansas City. Esther, always great to see you. So the decision's out, Esther. Was it the right decision, Esther? Would you have voted for the cut?
Well, I think highly expected. It is not a move that I could have supported. And again, I think, as you've heard from others, the Fed's inflation issue is a real one. Inflation is continuing on. It risks unhinging inflation expectations. And I think now is not the time to be cutting interest rates until you have clear line of sight that you've defeated this inflation.
Esther, is it a matter of this sort of vacuum of data that we have been in right now? Do you think that the Fed will be in a better position once we start getting that information?
Well, I think it's always helpful when you have reliable data, timely data to back up your decisions. That has been important historically, and I hope that gets back on track at some point. But the truth is, the Fed is not flying blind here. They have access to other sources of data. These tend to be long-run decisions. These are not just data point to data point decisions that they're looking at. And so important for sure, but I think is not necessarily going to reposition them around their bias right now, which has been to cut rates, even with higher inflation.
Esther, the other argument, the other side of the coin, just to get your take on this, is folks who say, listen, you had to cut because you have your eye on the labor market. And so the argument goes, Esther, if that labor market weakens on you, as a central banker, hey, it can weaken fast. And if it does, it can get out of control on you very quickly. That's why you've got to cut now. What do you say to that, Esther?
Well, I think what we've seen in the numbers, and I think we saw in the JOLTS numbers just this week, you see that, yes, firms are not making big moves to hire. And although we saw openings open up, you also see that people are staying with the job they have. So you don't see a lot of quits there. So that tells you there are things going on in the labor market that would not make you characterize it as robust by any means. But I don't think this is a labor market that's about to fall off the cliff either. And for the Fed, again, it's long-run decisions. The literature is pretty clear that having low, stable prices is really the key to supporting the labor market in the long run.
Esther, I'm really curious about someone who was a member of the FOMC, about the dynamics, the changing dynamics, seemingly more dissent within the Fed, and then, of course, the changing character of the Fed going into next year as we get a new chair. What is that going to do to the decision-making ability of the body?
Well, this committee has long-standing conventions around both its collegiality, its diversity of views, and trying to come to consensus. When you begin to see multiple dissents in a meeting, and we've seen this in the past, they come at times when the disagreements tend to be more fundamental, when things are less clear in terms of the judgments around the direction of the economy. And I think we're seeing that again. You don't want ideology to come into this. You don't want politics to come into it. And the committee is very careful not to let that happen. Of course, changes coming up will be the real test for the Fed. Notwithstanding all the concerns around Fed independence and how it might play out, someone has to get in the seat, and that will be their test. Will they think about the long-run issues that affect the American public, or will they think about shorter-term issues that I think will shape how this committee unfolds over the coming years?
Esther, earlier Julie asked a good question, and it's one I've heard others make as well. Some folks have been arguing, Esther, part of the reason they thought the Fed should cut is because they thought the Fed, by doing so, lower borrowing costs for low-income Americans who we know are under pressure right now. What do you make of that argument?
Well, my experience, Josh, is that lowering interest rates so that low-income Americans can take on more debt rarely helps them in the long term. So what it does do is, for those in higher income brackets, boost their asset portfolios and other things, I think, to a far greater degree than it helps that. I think this is why you have to be very careful in this kind of environment to think about how restrictive is this policy and what really are you trying to do relative to the long run benefits to the economy. These interest rates always fall disproportionately, whether you're a borrower or a saver. But I don't think that is really the answer to helping what we see as some of the disparities in households today.
And Esther, as we keep talking about that there will be a change at the Fed, and I've been sort of doing my own informal survey, trying to get people's votes. I'm curious who you think would be the best individual to lead the Fed as of next year.
Truly, it's really hard to say who would be the best because no one really knows how the job works until you get in it, until you face the circumstances you're in. So as you've heard others say, I think these individuals are qualified. The real test comes, though, for the individual that gets the nomination, gets the votes from the Senate, to see how they take hold of the committee, take hold of the challenges that they will face. And again, we can try to guess, we can try to speculate on what that might be, but the real test does come once you're in the seat and you think about the mandate in front of you.
Esther, always great to see you and to have you on the show. Thanks so much for your time as always. Appreciate it.
Thank you.
Well, Julia, on your point there, we'll just note the Journal is reporting your question there to Esther. Trump is planning to start his final round of interviews in the coming days.
Right.
Who's going to be the next Fed head? Lots of folks on there. Waller, Warsh, Hassett, we'll see.
Right. I believe our Jennifer Schonberger has confirmed that Warsh is on the short list. All right, let's go to Jay Powell now.
That was Federal Reserve Chair Jerome Powell wrapping up his news conference there, the last of the year, this coming after the Fed cut rates for the third straight meeting, this time 25 basis points. And in the Fed's economic projections, it points toward just one rate cut in 2026. One economist telling me earlier he doesn't see that cut coming until after the new Fed chair takes over. Markets, though, they like what they heard from Chair Powell, climbing to the highs of the day during that news conference. The Russell 2000, by the way, hitting a fresh record as well. Some of the highlights from that presser, Powell saying there is no risk-free path for policy, he says. Interesting comments on the economy. Expects to see a pickup in growth from today's relatively low levels of 1.7%, he said. Tariffs and inflation, touched on that. He said if you get away from tariffs, inflation is now in the low twos. Tariffs, he emphasized, likely to be a one-time price increase. Did field questions, a number of questions on the dissents. Said 9 out of the 12 voters supported today's decision, so he says there was fairly broad backing there. All right, for more reaction to the Fed's 25-point cut and Fed Chair Powell's commentary, let's kick it over now to Yahoo Finance Executive Editor Brian Sozzi, who is with Torsten Sløk, partner and chief economist at Apollo Global Management. Apollo, of course, is the parent company of Yahoo Finance. Brian.
All right, thanks so much, Josh. Torsten, good to see you here. Normally, I would start this getting your reaction on why the markets are ripping higher, the Fed cut rates. But I'm listening to the Fed chair, Torsten. I came away thinking this is the first meeting where the Fed chair is worried about the impact to the labor market because of the AI expansion in the U.S. and around the world. Is AI about to, I guess, just put a bowling ball through the labor market next year?
Well, he was asked that question by a number of the reporters, and this continues to be a very, very important issue because we just don't know quite yet how AI is going to impact the economy. We all know from our daily lives, AI is certainly helpful through large language models. That does increase productivity and how we do things, including here at Apollo. But it still is the case from a macro perspective that we just have to wait a little bit longer before we actually understand, is it going to create an increase in the unemployment rate? Because we're just not seeing that yet. Jay Powell also highlighted jobless claims have been very low. The unemployment rate has gone up a little bit, but it's not the case that we're seeing dramatic productivity increases. It's not the case that we're seeing a dramatic increase in the unemployment rate. So we still have to stay tuned a little while longer while we wait to see what the impact is of AI on the broader economy.
But a good number of jobs, and you heard, I think, the Fed chair hint at this, a good number of jobs could just completely vanish.
Yeah, there are a number of occupations, of course, that are vulnerable. Of course, telemarketers have often been mentioned. There's a number of things when we go down and buy our Big Mac at McDonald's, you now buy that on a screen instead of buying it with a human being. So there's a number of ways that this is being implemented that will absolutely create some very significant productivity gains, especially for some companies that are able to implement and do this in the right way. But at the macro level, and in particular from a Fed view, we just don't know quite yet what's going to happen, especially here in 2026, because we just don't know what the implementation degree and the adoption rate will be as we look ahead. It's all looking very positive, but at this point, it still remains highly uncertain what the impact is going to be on the economy.
Torsten, I know Josh back in the studio had a couple questions for you too.
Yeah, Torsten, I wanted to talk to you about this issue of affordability, this issue of economic anxiety, Torsten, that clearly a lot of Americans feel. It has become politically very sensitive. You see President Trump zeroed in on it now. Greg Ip had this piece in the Journal, Torsten, recently, and Greg kind of suggested, when we talk about affordability, it's almost a state of mind as it is anything else. I'm interested as an economist, Torsten. How do you think about the issue of affordability? How do you define it? Are we, do you think, in some type of affordability crisis? And what is the Fed's role here, Torsten, in tackling that?
Yeah, this is a really important question, because if you think about the basket of goods that we're all consuming, it is absolutely the case that the price of education has increased in the last decade, the price of healthcare has increased, the price of housing has increased. And if you add these three components together, you do get that they make up a bigger share of our consumer spending. So that's another way of saying, if I need to spend more money on healthcare, on housing, on education, well, that means that there's less money left to go on vacation, to eat at restaurants, to buy a new car. So that's why, from a simple CPI or consumption basket perspective, it is absolutely the case that there is just more money going now to the basic needs such as healthcare and housing that we just didn't have to the same degree earlier. To your question about what the Federal Reserve can do about this is a really difficult problem to solve, because essentially it's saying that some of the things that we are buying have just gotten more expensive. And if something has gone up in price, how does the Federal Reserve lower the price of those specific goods? That's just really difficult. There's actually not much they can do about that. Take, for example, one of them in housing. If you begin to see the Fed lower interest rates, that's probably going to increase home prices even more. So in that sense, the Fed doesn't really have any tools to solve the affordability crisis. So from that perspective, it remains a real challenge, as Jay Powell was also asked about here in the press conference, for them to really solve this problem that we're all talking about so much every day.
So let me ask you, Torsten, if the Fed doesn't have the tools, who does have the tools? Is it the president? Is it Congress, lawmakers?
Yeah, it is fiscal policy, and therefore, of course, also very importantly, Congress, because Congress could begin to do things to potentially cut prices in different ways, for example, of goods and food. This is exactly what the president has been doing. That's also what Congress has been moving in the direction of, saying maybe we should roll back some of the tariffs, especially on food, because this has, of course, turned out to be a very important area where we have seen some inflation. So, for example, tariffs could be lowered, which would then have the impact of lowering prices of food. You could also see other initiatives that could actually also have an impact on the housing market, where housing will become cheaper. For example, it could be that you could give some different subsidies or different tax incentives for households that then would have it a more easy time to enter in the housing market. For example, first-time home buyers, as also was discussed in the press conference, now the median age is about 40 years old. Well, if you now then try to lower home prices, not so much by lowering interest rates, but simply by giving tax subsidies to those who want to buy a home, then you could say, well, we're going to give $5,000 or $10,000, or it could be more or less, to those who want to buy a house. That could also be one way to help affordability. So the bottom line to your question is that there are things that could be done, but most of those things are absolutely on the fiscal side, meaning exactly to your point here. The question is, namely, is Congress going to do something on that? And will we see that? And that's, of course, where some of the action could be coming in order to get some things done in terms of affordability.
Torsten, we've got now a series of rate cuts from the Federal Reserve. We were just talking about AI driving more productivity. And I love what you have written recently, saying that we could have an inflation mountain. Are we looking at an inflation mountain? Rate cuts, AI productivity, and if so, where are we at in that mountain?
No, you're right, because we went through the first mountain was, of course, after COVID, where inflation went up to almost 10%, and now it's come down again to around 3%. The risk is that there's another mountain, because exactly as we're discussing here, you could have growth coming partly because of AI. There's also the One Big Beautiful Bill. The Congressional Budget Office estimates that the One Big Beautiful Bill, because one of the important laws in the One Big Beautiful Bill is that you could do immediate expensing of your capital expenditures if you're a company. In other words, if we had a company, we wanted to build a new building or a factory, we could write that down 100% immediately and deduct that from our taxes. Normally you have to do that over several years. If that's the case, you should expect to see a boom coming in the economy, especially when it comes to capex, not only in data centers, but also in business spending outside of data centers. So there are some tailwinds that argue for the risk that there could be another mountain in inflation coming along, simply because of the economy picking up in 2026.
Love this topic. Is that why we're seeing the market rally? I'm not going to say skyrocket, but we're seeing a strong rally off of this rate cut, because the market is sniffing out we are in the late stages of some form of economic boom, and that's going to send more people into Mag 7 stocks. And then are we in the middle of a bubble?
I do think that, very importantly, the narrative and what you and I have talked about through most of this year is that we had, of course, on Liberation Day, that the trade war came along. That was clearly expected to slow things down, and it did slow things down in a certain way. Not as much as many people expected, but we did begin to see a slowdown. But now that negative story, the baton is being handed to a much more bullish story for the economy and therefore also for the market going into next year, where again, fiscal policy, the one big beautiful bill is helpful, the data center build out is helpful. Given where stock prices are trading, high-end consumers, which was also discussed in the press conference, continue to still do well. All those things are building up to now for a narrative where we have been worried about a slowdown in growth to now more of an acceleration in growth. So we're really beginning to see the U-shaped or the Nike swoosh shaped here at the bottom of that begin to appear here in the near term. And as we get in particular to the second half of next year, we should begin to see things begin to accelerate. So in that sense, yes, both the worries about inflation going higher, but also tailwinds to growth and therefore also tailwinds to corporate earnings should begin to pick up as we get into 2026.
I wake up at the crack of dawn, I think it was a week ago, I get an email from you, 5 risks for 2026. And I love this list. I'm a big fan of lists, especially the ones that you always put out. But this one caught my attention. The new Fed chair lowers interest rates purely for political reasons. What is the risk to the economy from that? And what is the risk to the average investor from a move like that?
Well, one thing that's very important in financial markets is what's been going on in interest rates. We have seen, of course, the Fed has been signaling rate cuts. We just got a rate cut here. So that means that short rates have been going down. But despite that short rates have gone down since the Fed began cutting in September 2024, long-term interest rates have not gone down. So that's why this issue of when Jay Powell steps down in May of 2026, he was just asked about that. Will you stay on the committee? He again said...
Shocker, he didn't say anything.
He didn't say anything. Nothing new to report on that, as he said.
Keep it moving.
But the key issue is if the new Fed chair comes in and does begin to lower interest rates and push in that direction, we would have an even steeper yield curve, because that is basically saying short-term interest rates will be lower, and we should begin to worry about that inflation might be even higher than what we thought just a few months ago. And adding to that also additional fiscal problems, the answer to your question is that who the new Fed chair will be becomes very important, because that Fed chair will need to decide how much weight do they want to put on inflation being high and how much weight do they want to put on the weaker labor market. That is really, do you like apples and oranges? Because on the one hand, inflation high says that the Fed should keep rates high and maybe even be hiking. On the other hand, a weaker labor market says that the Fed should be cutting. So that's why it becomes really a difficult balance for them to figure out what will the new Fed chair do. And if the new Fed chair says, I'm going to ignore inflation, that's when we in markets, and especially in the equity market, should begin to worry about that maybe there is indeed a higher risk of this second inflation mountain coming next year, simply because of the Fed chair beginning to put more weight on the growth slowdown than on the upside risk to inflation.
For as long as you and I have known each other, we've always, when we talk about the Federal Reserve, we never really talked about it being politicized. But now that could in fact happen for next year. As an economist, how concerned are you that every Federal Reserve meeting could have some form of politics attached to it?
Well, the issue is we're already seeing with this meeting we had today 3 dissents. 2 dissents saying that we should be cutting, should not be cutting rates, and 1 dissent saying we should be cutting more. The fact that we're having dissents in either direction is already telling you that the movements are more now moving in opposite directions. Some people saying we should have more cuts, and others saying we should not have cuts. So we are beginning to enter now 2026, where we will, at the next few meetings, I totally agree with what you're saying, begin to see more evidence of just more disagreement. And maybe that's healthy that there is disagreement. You could look at this as democratic debate. But if the disagreement becomes so wide that out of the 12 voting members, let's say that they vote 7-5 that they did cut rates or they didn't cut rates, you and I would call each other and say, wow, that's really unusual, because we have not seen that for a long time. So in that sense, we are entering uncharted territories here where we might begin to see much more disagreement. And the question is how equities are going to trade on the back of that if we do not have the clear, strong messaging from the Federal Reserve that we all have been used to.
Torsten, so good to see you. Thank you so much for doing this. I really appreciate it. Very important day. Josh, back to you.
All right, Brian, and we will be back to you shortly, my friend. Thank you. And for more on what we heard from Fed Chair Powell after the latest rate cut, let's welcome back in here Stephanie Aliaga, Global Market Strategist at JP Morgan Asset Management, along with Jeff Klingelhofer, Aristotle Pacific Managing Director and Portfolio Manager. This coverage brought to you by Capital Group. Stephanie, I'll start with you. You were listening to Jay Powell there. You were taking notes. What were the highlights to you, and what do you make of this market reaction? The S&P 500 is heading for a record close. The Dow, Stephanie, is up more than 600 points.
Yeah. I think that Powell struck a pretty constructive tone at the press conference, and that is far better than I think what some really feared heading into this meeting. I think a lot of investors, this was one of the last major catalysts, and if you had a reason to just wait on the sidelines a little bit, this was that meeting, and so now there is just more of that inertia, that enthusiasm around going into risk, and for reasons that Powell cited, AI is providing a tailwind for the economy that is expected to grow. The consumer's hanging in there. It may be K-shaped, but that K-shape is still going up in aggregate. And then overall, I think, the fact that you just have less uncertainty around the pathway forward for interest rates, which is so key. The MOVE index, which tracks the volatility around treasury yields, it's at its lowest level since November of 2021. So for bond investors too, we're now looking at the next year, and at least we're going to have more certainty around our returns, where our yields are still going to be relatively elevated.
Jeff, U.S. bond yields are falling here across the curve. The 10-year, 4.14. What were your highlights?
Yeah, I think very similar to the conversation already. I was expecting something a little bit more spicy. I was surprised this was a relatively neutral.
You didn't get spicy, Jeff.
Well,
not too much spice.
I don't know. I think there was a tall glass of milk and a Pepto-Bismol chaser in front of every member is what I would say. But look, if we go back to the last meeting, Powell used language that there was strong disagreement, and we didn't get that today. But we did get an additional dissent. And so I think the biggest thing to me that I take away from this press conference is ultimately that the FOMC is still relatively of the view that the next move is lower. Now, I think they basically took January as a done deal off the table. I think the bar is very, very high, but they are still viewing that the next policy move is lower. And so I'll go back to something Torsten was talking about, right? That next potential wave. I still think there's a lot of questions, there's a lot of data to come, and I suspect that what we will see is a reaffirming of inflation, and that will shift the narrative at some point.
Stephanie, did you see or hear anything today that made you reconsider how and where you want to put money to work, where the opportunity is?
Not necessarily, and I think that's because this press conference didn't really deliver a lot of surprises. I think when it comes to the AI theme, one thing that Torsten was talking about too is that in regards to the labor market, which seems to be the big unknown here, because we kind of know what's happening on the inflation front. Tariffs, they're going to give and then they're going to take, right? But on the labor market, there's a lot of questions around: are companies really hunkering down, pulling back? Is AI having an impact here? And I'll say, in the data itself, the narrative around AI impacting layoffs seems far greater than the actual scale. So in the Challenger data, actually less than 5% of the 1.1 million announced job cuts this year are even related to AI. And that equates to just 0.03% of total employment. So if AI is not having a big impact, corporate America is doing quite well. Mid-double-digit earnings growth expected next year. And tariffs, they're having an impact, but it's receding in terms of the most feared outcome here. This is an environment where I think the labor markets are going to stabilize.
On the labor market, Jeff, I have had folks on the table say, here's what's going on with the labor market. Some economists made this. They'll say, on the supply side, it's boomers are retiring and they're not easily backfilled, and you have stricter immigration policies. On the demand side, they'll say it's AI having a big impact. I guess their point actually is the Fed really can't do much about that, but I'm curious to get your thoughts.
Well, I think that's right. The Fed would have a very significant challenge in propping up the labor market if it is due to AI. And I think we saw Powell address that very directly. Look, I think we're in the midst of the conversation around AI beginning to shift. And right today, it's focused on what happens if it's not successful. Are we in a boom-bust cycle? And I think what the conversation really needs to shift to is what happens if it is successful and the immense implications that it has on the labor market. But on the flip side, right, I think what we will see is that the Fed ultimately doesn't have the tools to tackle that. But I'll push back against something also that Torsten said. They do have the tools to bring down demand. They do have the tools to continue to push against inflation. We just don't like what that does to the economy.
Stephanie, let's bottom line this. For viewers who are listening right now, they're thinking, okay, well, what do I actually do with my money now in this environment? What are you advising those very smart JP Morgan clients? In the stock market, 2026, where do you tell them, at least at a sector level, here's where we think the opportunity is?
Markets in recent weeks have been a lot choppier. I think there's some anxiety around after 3 years of blockbuster returns because of AI. Valuations are elevated, markets are expensive, and concentration is quite acute. In light of all that, we still really like the core fundamentals powering this market. However, There may not be a big systemic bubble, but there could be little ones. And we think moving forward, investors really ought to emphasize quality, the kind of companies that are cash generative, where you have clear monetization around AI, around investment, and also diversify some of that exposure to the mega caps. Because what we're also saying is there's a lot more dispersion underneath the hood in this AI race, and we think that that's going to continue. There could be all sorts of surprises when it comes to AI. This is a never-before-seen transformative technology. You just want to make sure that your portfolio is built to withstand whatever may come.
Jeff, final question to you. Fixed income viewers, right? Investors are listening right now. They want guidance and advice. What do you tell them, Jeff?
Yeah, I think very similar to Stephanie, right? What we see here is ultimately an economy that is firing on all cylinders. There's a lot of tailwinds with one big, beautiful bill. And at Aristotle Pacific, one of the things we are constantly assessing is that relative value in the world of credit. We like the world of credit, but we're a little bit more cautious on this particulars of where, right? Focusing on fundamentally good cash flows, defensible cash flows, defensive parts of the markets. That's where our emphasis is. I think we're a little bit more reluctant on rates. It's a little bit more two-sided than perhaps the Fed chairman gave credit for today. And so it's about how we pair those in pursuit of an outcome. But really, it's a market, credit is the catalyst here looking forward.
Jeff, Stephanie, so good to have both of you on the show today. Thank you so much. Appreciate it. Let's get back to Jennifer Schonberger at the Fed. What were your takeaways from Powell, Jen?
Hey there, Josh. Fed Chair Jay Powell signaled that the central bank is likely to take a pause in cutting rates come the new year as the Federal Reserve takes stock of the economy. Take a listen.
The adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
Indeed, the Federal Reserve is going to get a deluge of data starting next Tuesday, and Chair Powell cautioned that that data could be distorted given that we had the government shut down for all of October and the first 2 weeks of November. And so they're going to take a skeptical eye to that data, indicating that perhaps they may not be getting a clear picture on the economy until after January. Now, as far as inflation, he said that most of the inflation he believes is coming from the good side, that is coming from tariffs. And he believes that if we don't have any new tariff announcements, that is likely to peak in the first quarter. He also shed some light on why the Fed opted to cut today versus in January, something that it seemed the Fed chair had signaled at his press conference back in October. And that is because he said he believes that the jobs numbers have been overstated and by 60,000, and therefore we could have seen over the past 3 months negative job growth of 20,000 per month. Now, President Trump weighing in on the Fed's decision just moments ago, saying that he thinks the Fed should have cut by 50 basis points, and certainly the Fed governor that he appointed, Stephen Myrid, dissented in favor of that. Josh?
All right, Jen, thank you. And now let's get back to Yahoo Finance's executive editor, Brian Sozzi, live from Apollo Global Management. Brian.
All right, thanks so much, Josh. Yeah, here with Scott Kleinman, Apollo Asset Management co-president. Good to see you, Scott. I appreciate it. So this is Fed Day in America. Fed cut rates by 25 basis points. How does this impact what you do in your business?
In reality, 25 basis points doesn't really move things one way or the other. Directionally, right, we've seen rates starting to slide down a little bit, but realistically, we're not going back to the days of 0% risk-free rate. So in the grand scheme of things, there's a cost of capital, that's required for borrowings, for, factoring into valuation. So doesn't really change things all that much.
You're going to take me back to my spreadsheet crunching days there. Look, we had one dissenter at this Fed meeting who wanted, I think it was Stephen Myrid, who wanted a 50 basis point rate cut. The companies you touch and see, the executives you talk to, is the economy in a place that would warrant a 50 basis point cut?
I do feel for the Fed governors here who have to make these decisions because we are getting mixed economic data, right? On the one hand, we're seeing unemployment, creeping up. On the other hand, inflation stays stronger than I think people would anticipate. The U.S. economy has been shockingly strong for the last several years, right? I mean, we saw almost 500 basis points of rate moves, couldn't really slow the economy down. We've had some other actions out of this administration that on paper should have slowed the economy down, but has not really slowed the economy down. So it's really trying to land an aircraft carrier in the middle of the ocean land the airplane on an aircraft
totally
carrier.
Easy.
So it's hard to really know. I think we probably don't need a whole lot more rate cuts. We'll put it that way. The economy is still chugging along pretty soundly. And if I were in charge, I'd say let's pause for a little bit and see.
The job's open.
Yeah, exactly.
The job is open. So, talk to us about deal making. I think the Fed signaled one more rate cut for next year. Whatever it is, they are cut rates by 175 basis points now. What does it mean for deal making?
Yeah, look, it's actually been a pretty good environment for deal making. Over the last couple of years. You got to separate what's in the inventory of private equity portfolios and new deals. That 18 to 22 timeframe when rates were, like I said, essentially 0% cost of capital, you had a lot of great companies purchased by the private equity industry, but at pretty lofty valuations. And so private equity inventories are pretty full right now. For the last couple of years, it's been more difficult for the typical private equity firm to sell assets because that rate move has changed the valuation environment. And so you have portfolios full of good companies, but bought at the wrong price. I think as rates start to creep down a little bit, that will allow a little bit more companies out of inventory, if you will. I also think the passage of time helps. Companies can grow into these loftier valuations that folks were hoping for. Fortunately in Apollo, I like to joke we never got the memo that the cycle was going to last for 15 years. Mm-hmm. So we stayed true to our value orientation. And that's allowed us to actually be exiting even in this environment. And so, like for example, we've had 4 IPOs since Liberation Day. We've continued to sell assets, and feel pretty good about that. As far as new deals go, no, it's a pretty good time to be buying stuff.
What sectors you think? What attracts you right now?
For us, we are opportunistic investors. We look for where there's interesting value, and so notwithstanding the S&P sort of hitting new records every couple of weeks, it really is concentrated in a handful of names. If you look back at sort of the S&P up 25% last year, teens this year, that performance is not spread evenly. You have 10 stocks that were up, 50+% last year, and I think the average company in the S&P was up 6%. A third of the S&P was down last year, right? So you have a lot of interesting companies, industrials and consumer financial services that have not really seen the type of performance that the headline S&P numbers have shown.
Exits have picked up, which is, I imagine, good for your industry. Is next year the year of the big exit? You see that momentum continuing?
Yeah, I think it will continue. I don't think it's going to be a whopper of a year or materially better, but every year that passes where a recession doesn't come, you have companies that are just continuing to grow, accrete into those valuations I was referring to earlier, and that allows sponsors to sell a little bit more out of their portfolio. So I think it's the passage of time more than anything else, unless we believe we're going back to a zero rate environment, which I don't think. Then I think you'll see marginally better, but rates are still going to be 3.5%. They're not going back to zero.
What is the secret sauce on knowing when to exit? What do you look for specifically? How do you know the environment is right to sell a portfolio company?
Yeah, for us, it's because so much of our investments are based on like an investment thesis. We're buying a company that needs a transformation, that is trying to get from point A to point B. We're typically looking to exit when we've, mission accomplished. We've achieved, the big lift that we're trying to achieve. The beauty of private equity is you don't have to be market timers. You don't have to get the timing perfect if you've paid a reasonable valuation on the way in and you've created a lot of good things along the way. And so it's less about the perfect timing, although when the perfect market conditions exist, it may not be according to your schedule, and so sometimes you have to lean in and just say, you got to make hay when the sun is shining.
Lastly, you've been at Apollo since, 1996?
Correct.
How is the private equity industry, how's it changed? Like, what's the biggest change you have seen?
Yeah, well, obviously the scale. When I started 30 years ago, private equity was a cottage industry. It was, maybe it represented 0.5% of GDP. Today it's, I've seen stats somewhere between 10 and 15% of GDP is private equity-owned companies. And so it's just a much bigger part of the whole ecosystem. Obviously, the scale in which you can do transactions. The beauty of Apollo is, though, the secret sauce that made us great, 30 years ago is what holds true today. Find good companies, pay a reasonable price for them, operate them well, and be thoughtful about when you exit.
Thanks for letting me in the building. I appreciate it, Scott. Good to see you here. Happy holidays.
Always good to see you as well.
Thank you so much. All right, Josh, back to you.
All right, thank you, Brian. Appreciate it. Coming up, we're taking a look at shares of Nvidia, which is facing new headwinds thanks to China. New questions for Nvidia around its chips in China, just after President Trump gave the company the green light to ship its H200 AI chips to China. Concerns are being raised about chips being smuggled there. Yahoo Finance's Dan Howley is here with more. Dan.
That's right, Josh. This is a report from Reuters basically saying that there's this gray market that exists where some universities, perhaps even those linked to China's military, already have access to some of NVIDIA's high-end H200 chips, or that they've been putting out offers to purchase them throughout the past couple of months. And so, this actually would run counter to the U.S.'s plan to cut off China and its institutions from access to Intel's chips. There was obviously the H20 that was originally allowed to ship there. Then President Trump had said, actually, no, we're not going to send it there, and then flipped that and said, sure, we can ship it there. But at that point, China had said, we don't want that. It's degraded. We want something more powerful. And so he announced that the H200 could ship there. NVIDIA's denied this. There's been several reports in the past where there's been accusations that some third parties have been able to gain access to NVIDIA chips and then ship them over, in pallets, things along those lines. NVIDIA's denied that, saying that doing so would be impossible. That they're the only ones that really know how to get these things up and running, and that they need access to the software to be able to run them properly. And so, it does appear that this is going to be something that dogs the company going forward, unless the H200 ends up being sold into the country, and then this could all be for naught.
Dan, NVIDIA in that statement, I'm just seeing reports, according to the spokesperson, they actually characterized such smuggling. They said it seems, in their words, far-fetched. What's your take on that? How far-fetched would this be? How tough does it sound like this would be to pull off?
I mean, to get these server racks into another country where they're not allowed would be difficult. Then again, we also just saw reports that some Intel and AMD chips were being used in missiles and drones that were attacking in Ukraine. They're actually being sued for that now, the companies. And so, it does seem as though it would be very difficult. Obviously, NVIDIA would probably work as best as it could to stop it, but that doesn't mean that determined individuals wouldn't be able to get access to these in some form or fashion. And so, it could be the company's telling it it's far-fetched, but, stranger things have happened, right?
You sure have. Dan, thank you, buddy. Appreciate it. Oracle earnings on deck. We've got full coverage after the close.